At the precise moment generating this analysis, Nuburu, trading under the ticker symbol BURU, is changing hands at exactly $0.2347 per share. The market is currently open and active, and we are seeing a modest intraday upward movement of roughly 0.56% to 0.70%, depending on the exact second you glance at the tape. The stock opened the session near $0.2359, pushed to a high of roughly $0.2381, and has found a temporary floor around $0.23. While a movement of a fraction of a cent might seem negligible to the uninitiated, in the world of microcap equities, this stability is the calm before a potential storm, or perhaps the silence of a slow drift. The volume is ticking over significantly, showing that despite the low price tag, eyes are watching and algorithms are churning. The expectation most investors have when they see a stock trading under a quarter is that the company is effectively on life support, a zombie ticker waiting for a final delisting notice to put it out of its misery. You look at the chart, you see the massive decline over the last year, and the natural instinct is to look away, assuming there is nothing here but a cautionary tale of capital destruction. That is the expectation, a dead end. The reality, however, is far more complex and potentially explosive. Nuburu isn't just a penny stock selling vaporware. They hold the intellectual property for a technology that physically changes how we manufacture the most critical components of the modern energy grid: blue laser technology. The reality is that while the stock price suggests bankruptcy, the company is aggressively expanding its footprint through acquisitions like Liacon and partnerships with defense entities, positioning itself as a critical supplier for the next generation of manufacturing. This tension between a basement-level stock price and a ceiling-shattering technology creates a curiosity loop that demands we look closer. We are not just looking at a stock chart. We are looking at a wager on the physics of light itself. Let's strip away the noise and look at what is actually happening on the tape today. The stock is hovering in this 23-cent to 25-cent range, a tight channel that often indicates consolidation. When you see a stock like this flatten out after significant volatility, remember this is a ticker that has seen massive spikes of 25% or even 60% on news releases recently. It suggests that the weak hands have largely exited. The sellers who panicked are out. Who is left? Speculators and perhaps some accumulation by those who understand the underlying asset value. If you were trading Tesla stock today or Nvidia stock, you would be looking at massive liquidity and institutional walls. Here in the microcap trenches, the game is different. You're fighting against liquidity gaps. A small buy order on a platform like Robinhood or a more sophisticated entry via interactive brokers can actually move the needle here more than you would expect. The volume we are seeing, over 5 million shares traded relatively early in the session, tells us that the market has not forgotten BURU. There is a heartbeat. The core of the reality that contradicts the bearish expectation lies in the physics. To understand why anyone cares about a company valued at a fraction of a dollar, you have to understand the color blue. Traditional industrial lasers are infrared. Infrared is great for cutting steel, which is why it dominated the automotive industry for decades. But infrared light has a problem. It is terrible at being absorbed by copper and gold. It bounces off. This is a nightmare for manufacturing electric vehicles, where everything is copper wiring, copper bus bars, and battery tabs. Nuburu's blue laser is absorbed by copper 13 times better than infrared. This isn't a marginal improvement. It is a step change in physics. If you're a manufacturing engineer at a company trying to build millions of EV batteries, you don't just want blue lasers, you need them to increase speed and reduce defects. This connects directly to the broader narrative of Tesla stock and the EV sector. The bottleneck is often not demand, but manufacturing throughput. Nuburu claims to solve that bottleneck. However, a great technology does not always make a great stock, and this is where we have to be brutally honest about the financial picture. The company has burned cash. The 1-for-40 reverse stock split executed earlier in 2024 was a desperate move to maintain listing compliance. When a company does a reverse split, it is often the kiss of the death for retail sentiment because it highlights weakness. But look at what they've done since then. They didn't just curl up. They announced the acquisition of Liacon, an Italian laser firm, to expand their manufacturing capabilities and reach in Europe. They announced partnerships in the defense sector. They are pivoting from being just a science project to an integrated industrial player. This is the contrarian take. The reverse split cleaned up the share structure, and the current low price might represent a reset valuation that ignores the strategic assets they have accumulated. This brings us to the mechanics of how you might approach this. If you are sitting there with your Fidelity account, looking at Fidelity mutual funds or Fidelity ETFs, you likely won't find BURU in the top 10 holdings of a conservative growth fund. This is off-road investing. This is for the part of your portfolio where you accept the possibility of total loss for the chance of a 10x return. It is distinct from the passive safety of Schwab Intelligent Portfolios or the automated ease of a SoFi robo-advisor. Investing in BURU requires active management. You need to be watching the news feed for contract announcements. A single press release about a contract with a major Tier 1 auto supplier or a defense contractor could send this stock up 100% in a pre-market session. We have seen it happen before with this ticker. The volatility is the feature, not the bug. Comment below how many shares of Nuburu you currently hold, or if you are waiting for it to break a specific resistance level like 30 cents before you jump in. It is always fascinating to see where the psychological entry points are for the community. Let's discuss the defense angle, because this is where the expectations of a commercial failure might be met with the reality of government spending. The Department of Defense and related entities are increasingly looking for directed energy weapons and advanced manufacturing for drones and aerospace. Nuburu has been signaling a hard pivot toward this sector. The acquisition of Liacon isn't just about commercial lasers. It's about having the industrial base to supply high-reliability components. If they can secure a foothold in the defense supply chain, the revenue quality changes. Defense contracts are sticky. They provide long-term visibility that commercial sales often lack. This would stabilize the cash flow and could force a re-rating of the stock. Investors looking at Interactive Brokers stock trading data might see increased interest in the aerospace and defense manufacturing subsector, and Nuburu is trying to draft behind that momentum. We must also consider the competitive landscape. You have giants like IPG Photonics or Coherent. These are the Apple stock equivalents of the laser world, massive, cash-rich, and dominant. Nuburu is the tiny disruptor. The risk is that the giants simply wait for Nuburu to run out of cash and then buy the IP for pennies, or they develop their own blue or green laser solutions. But Nuburu has a head start and a thick patent portfolio. The moat here is the IP. For an individual brokerage account holder, the bet is essentially on whether Nuburu can commercialize fast enough to survive, or if they make themselves attractive enough to be bought out at a premium significantly higher than 23 cents. When you use investing sites or apps like Robinhood app to track this, pay attention to the average daily volume. If you see it drying up, if the stock goes days with very little trading, that is a bad sign. It means interest is waning. But if you see consistent volume like we are seeing today, millions of shares traded relatively early in the session, it means the battle is ongoing. The bulls are betting on the turnaround, the bears are betting on dilution and cash burn. The company has had to raise capital, and that often hurts the stock price in the short term. Every time they sell shares to keep the lights on, your slice of the pie gets smaller. This is the classic dilution death spiral risk. But if the capital raised is used to buy revenue-generating assets, like Liacon, then the dilution might be accretive in the long run. It is a race against time. Let's look deeper at the Liacon deal. Why does an American blue laser company want an Italian firm? It's about integration. Selling a laser source is hard. You have to convince a machine builder to use your engine. Selling a full solution or having a partner who builds the machine makes adoption easier. It lowers the barrier to entry for the customer. This shows that management is listening to the market. They realize that just having the best bulb isn't enough. They need to own more of the fixture. This kind of strategic thinking is what you look for in a turnaround. It is not just hope, it is execution. For those of you who use SoFi Investing or SoFi Active Investing, you know that the platform encourages looking at the community sentiment. In stocks like BURU, sentiment is a leading indicator. If the message boards and social streams are quiet, the stock drifts. If the chatter picks up about 3D printing or copper welding, the stock moves. Nuburu is heavily tied to the 3D printing narrative as well. Metal 3D printing is the holy grail of manufacturing, but it is slow. Blue lasers can speed it up significantly. If the